Understanding market movements is valuable to traders whether the prices are rising or falling. Shorting stocks or buying put options are common methods, but the bear put spread is a cost effective alternative for downturns. Shorting stock requires traders to have a margin account with at least 50% of the stock's value available for margin. This could tie up a substantial amount of capital. While a long put can yield sizable theoretical profits, it's unlikely for stock prices to drop to zero, often stalling or bouncing at support levels. The bear put spread is a debit vertical spread combining a short put leg with a long put in the same stock and expiration. Adding the short put will limit the downside profits to the difference between the strikes minus the premium paid to open the spread. But the premium collected from the sale of the put offsets the cost of buying the long put, making it more economical. This lower cost can lead to a higher rate of return compared to the long put strategy. Of course, no strategy is immune from losses. If the price of the underlying rises above the long put strike and the options expire, the bear put spread will lose the premium paid. Option sellers also face assignment risk, potentially requiring the exercise of long calls to cover the assignment. TradeStation's clients can use the power of radar screen to identify bearish stocks in real time. The sample workspace accompanying this video includes a radar screen and two charts, utilizing indicators like open interest all options, volume average, percent change, MACD, and RSI to filter for heavily traded stocks with liquid options. Using radar screen filters, we can find stocks that are triggering bearish signals that could indicate the start of a downtrend. To go through an example, let's examine a bear put spread on Hewlett Packard Enterprise Company. Using OptionStation Pro, we will load option chains for HPE and build the spread by selecting the options legs individually. Time decay on this debit spread begins with minimal impact on the option's value and intensifies over time. We can opt for options with expirations exceeding 60 days from now to minimize the impact of time decay. As the expiration date approaches, particularly within the last 30 days, the impact of time decay grows exponentially. To counter this, consider closing the position approximately 30 days before the option's expiration. Careful selection of the long put strike is crucial for risk management. The premium paid for the long put minus the premium collected from the short put will determine the spread's cost and potential loss. Additionally, the long put contributes to the spread's potential profit. Its value may increase as the underlying price drops or volatility rises. While opting for deep out-of-the-money puts may seem appealing due to lower premiums, they require more substantial price movement for profitability, diminishing the likelihood of a profitable spread. We can choose a strike near the current underlying price for our bear put spread. Choosing the right strike is vital. A strike near a resistance level where prices are expected to drop can be a strategic move. Timing the entry to coincide with the underlying price at or bouncing off the resistance level may further improve the premium. In our example, using radar screen filters, we identified HPE as being bearish. Looking at its chart, the price appears to be in a downtrend and halfway between resistance and support. Price recently pulled back to a supply level, but there are probabilities that it may continue to drop to its support. To select the long put, click its ask price. The put options row is highlighted in blue and is added to the trade bar below. Once the long put is selected, a lower strike put is sold simultaneously to create the spread. Choose a strike to maximize premium collection while ensuring it remains sufficiently distant from the long strike to allow for potential profit. Hold the Control key on the keyboard and click the put's bid price to add the short leg to our spread. The short puts row is highlighted in red and is added to the trade bar below. The vertical line next to the strike prices changes from green to profits and red for losses, reflecting the impact of the underlying price movements. The point where the line shifts color represents break even, calculated as the lower strike price plus the premium paid. The trade bar displays the spread as a vertical, indicating key parameters such as max profit and max loss. While selecting a price between the bid and the ask by clicking the mid button might offer better pricing, let's opt for the natural option. This will populate the price box with the actual buying and selling prices of the puts in our spread, improving our chances of getting filled. Review the order details and click Place Order to send it to the market. Confirm the order and monitor its status on the Manage tab. Right click on the open order if you wish to cancel or replace it. Once filled, individual legs will appear in the positions panel below. Drag and drop one leg onto the other to group them as a spread. Right click on the spread and select Close Position if you wish to set a profit target or a stop loss on the position. The bear put spread is a multi leg strategy that attempts to capitalize on declining stock prices while managing risk. It involves buying a put option and simultaneously selling a lower strike put. The strategy thrives in environments with increased volatility and downward movements in the underlying stock price. While putting a cap on potential rewards, the bear put spread also limits potential losses. Successful implementation requires careful strike selection and diligent trade monitoring. Traders will typically try to lessen the impact of time decay by selecting to close the spread before options expiration. Before trading, practice in simulated trading mode on TradeStation to build confidence without real financial exposure. Access the downloadable Workspace and instructional PDF guiding you on utilizing Radar Screen to identify bearish stocks. Then learn how to integrate OptionStation Pro for effective bear put spread trading. Explore additional training and elevate your skills by tapping into the comprehensive resources within this option series.